Just so you know, I want you to know this. Panic in the banking sector has not ended yet. Fear still exists. So the situation has gotten better compared to the past few days, but the question is, are we out of the woods yet? In today's video, I want to cover Deutsche Bank, and then we'll talk about banks in the US. So here's what you need to know. People are saying that Deutsche Bank may be the next domino to fall. So is that true? Is this fear overblown? So let's talk about this. I'm going to give you the circumstances and you can be the judge. So here's what's going on. Fear in the banking sector has now been spreading to Deutsche Bank. And this is a big deal because Deutsche is Germany's largest bank. They do home loans, business loans, they do trading, corporate M&A, etc. They have $1.5 trillion of assets, 85,000 employees in 58 countries. So they're basically you could think of them as the JP Morgan Chase of Germany. So as you know, we had Signature, Silvergate, we had Silicon Valley Bank go down. Credit Suisse, they had to get emergency aid and that wasn't sufficient. So then they needed to get rescued by UBS in a government-backed deal. So regulators and central banks, they were hoping that the banking crisis just ended there. They put it out. But the fall of Credit Suisse, it's been pushing up the funding costs of all banks all throughout Europe. And the fear of contagion, it's now been spilling over to Deutsche. But the question is this warranted? So the concern with Deutsche Bank is their exposure to commercial real estate in the US. Additionally, they have a large book of derivatives, but obviously that's not surprising considering the size of their bank. So here's the thing. I would say that it wouldn't be fair to compare Deutsche Bank to Credit Suisse. That's because Deutsche Bank, they made a profit of $6 billion last year. So that was their largest profit in 15 years. Credit Suisse, in my opinion, they were a dumpster fire that's been raging on for years. We already dedicated a video just to Credit Suisse just a few days before they went down. But if you remember, during the Great Financial Crisis, yes, Deutsche Bank, they were in jeopardy of failing. However, it's been a while. And since then, they've implemented a turnaround plan and it's been going well. It's been especially going well for the past few years, the past 5 years. So listen, is Deutsche healthier than Credit Suisse? The answer is yes. Nobody's going to argue that. Nobody's going to question that. But that's not the right question to ask. The proper question to ask is Deutsche healthy enough to withstand the more challenging banking environment that's coming up ahead? Well, I'm going to give you the two opposing arguments. The first argument is that this fear on Deutsche is not justified. Their turnaround plan, it worked, they're profitable, and their capital buffers are very healthy. The German chancellor said there's no reason to be concerned about Deutsche. He said, and I quote, Deutsche Bank has modernized and reorganized its business model, and it's a very profitable bank. Stuart Graham from Autonomous Research said, to be clear, Deutsche is not the next Credit Suisse. The bank is solidly profitable, they have their strongest capital ratio since the 1990s, and they have lower interest rate risk. So Citigroup said that the sell-off in Deutsche, it is just plain irrational. However, some investors are skeptical because that's what they said about Credit Suisse before things spiraled out of control. So the pricing on Deutsche Bank's credit default swaps, they've been surging. That's been setting off alarm bells. Credit default swaps, those are derivative contracts to insure debts against default. So we're talking about the cost of insurance for Deutsche Bank's bondholders. So Deutsche Bank's bondholders, they're getting nervous because Credit Suisse's AT1 bonds, they got wiped out for $17 billion when they accepted the UBS deal. So, obviously this is in addition to the macroeconomic fears, instability in the banking sector and the higher interest rate environments. And on top of that, you throw on contagion. So there it is. That's the current situation with Deutsche. And this is so important because Deutsche is systemically important to the whole banking system. We're not talking about just in Germany or just in Europe, but we're talking about internationally. And if you think about it, okay, you have to remember that US regulators, they needed to get involved in the Credit Suisse UBS deal. So you can bet that Jay Powell and friends, that's the major central banks, they're trying to make sure that nothing goes wrong here at Deutsche. So they need to stop contagion, they need to instill confidence. So that's why Deutsche is crucial in this evolving story of panic in the banking sector. Now, I want to update you on the banks in the US. So here's the current status. Jay Powell, Treasury Secretary Janet Yellen, and other officials, they held a closed-door meeting on Friday. So this was the Financial Stability Oversight Council. So their official statement was, the council discussed current conditions in the banking sector and noted that while some institutions have come under stress, the US banking system remains sound and resilient. So they basically said all good. So everything's good, no worries. That's all they said. No further details were provided. Now on Friday, data from the Federal Reserve shows that bank customers pulled out $98.4 billion from their bank accounts during the week ended March 15th. So that means that bank deposits fell by 0.6% to $17.5 trillion. So that covered the time frame when Silicon Valley Bank was going down. So most of that $98.4 billion, that was coming out of the smaller banks. $67 billion of that went to the larger banks. So basically, people were pulling money out of the smaller banks and they were putting that into the bigger banks because they felt that their money was safer at the bigger banks. So let's speak honestly here, because the officials, this is what they wanted to say, but they can't say it, obviously. If a small bank fails, and the government and regulators, they don't care. If you're a bigger bank and you're at risk of failure, then the government, yes, they will care a little bit more. But if you're one of the top 5 big banks, we're talking about JP Morgan Chase, Bank of America, Wells Fargo, Citibank, US Bancorp, then your money will be much safer there because those banks, well, they're considered too big to fail. The government will not allow those banks, the top 5, to fail. If one of those top 5 banks were at risk of collapse, you know that they would get bailed out and that your money would be safe. So that's the reasoning and the logic why depositors pulled out their money from the smaller banks and they were putting them into the bigger banks. So, I mean, that makes sense, right? So the status update on the situation is that the rush of outflows from the smaller banks has now slowed down considerably. Jay Powell said that deposit flows have stabilized over the past week. But the smaller banks, at the end of the day, they still got hurt. The money has not returned. They just stopped the bleeding. That's what happens. So data from Thursday shows that institutions have been drawing $116 billion from the central bank's discount window to boost liquidity. So that is the highest amount since the great financial crisis. The daily average in the Bank Term Funding Program has been $53.7 billion. So currently, we don't know how much further government intervention that there's going to be. And we're getting mixed messages from Treasury Secretary Janet Yellen, so that doesn't help. In Yellen's Senate hearing, she said that uninsured deposits would only be guaranteed in banks that could cause contagion. So basically, they're saying that they're going to protect depositors at the bigger banks. And Yellen clarified that she will not offer protection to depositors at all banks. So she's saying that there's not going to be blanket insurance. However, the next day, Yellen said that the government is ready to take more action. So we don't know what they're going to do next, and we don't know what's the threshold to classify a bank as large enough or important enough to receive this selective protection. So ultimately, they're playing favorites here, and the favored banks are the bigger banks. Now, this is problematic, and here's why. So you could think about this logically. If only the depositors at the bigger banks will receive this protection, then customers are going to feel more comfortable. They're going to feel more secure leaving their money at the bigger banks. This is going to cause smaller banks to either go out of business or it's just going to make them weaker. And the bigger banks, they're just going to get bigger, they're going to get more powerful, and there will be consolidation in the banking sector. But you have to know that small banks they're so important. Small and mid-sized banks, they account for half the commercial, industrial, and residential lending in the US. But a lot of that money in business, it may shift to the larger banks because of this unfair treatment, because it's advantageous to the bigger banks. And the larger banks, again, they're just going to become even bigger. But the bigger banks, they're aware of this. I mean, obviously, they know the situation. They know what's going on. But they're saying that they don't want to take advantage of the situation. That's what they're saying. So, for example, First Republic Bank, they were the 14th largest bank in the US at the end of 2022. So number 14, that's very large, but that's not in the top 10. And there's a world of difference if you're in the top five, the five that I mentioned. First Republic Bank, they recently saw a bank run. So you know how I said that a lot of money left the regional banks and the smaller banks, and that money went to the bigger banks, right? Well, JP Morgan Chase coordinated a plan. So they coordinated a private sector plan to help First Republic Bank. 11 of the larger banks deposited $30 billion into First Republic Bank to help them out. So they didn't have to do that, but they did. So that was their show of goodwill to help out a smaller bank, even though that they're a competitor. So the bigger banks are trying to demonstrate that they're not trying to take advantage of the situation and they're not trying to eliminate the smaller banks. The bigger banks, including JP Morgan Chase, Citi, and B of A, they've been telling their employees not to poach the clients of smaller banks. JP Morgan told employees they should never give the appearance of exploiting a situation of stress or uncertainty. So listen, I'm watching the situation carefully in the banking sector, domestically and internationally. We don't know how bad the situation is going to get with the degrading macroeconomic environments in a high interest rate environment. We don't know what else the government is going to do, what the Fed and central bankers will do as a countermeasure. But I'm going to keep you updated on the situation and let me know what you think. Please subscribe. I thank you for all the support and I wish you a very nice day. Take care.